Testing, 1, 2, 3. Testing, 1, 2, 3. All right. Good morning, guys. How are you doing? Another day, another dollar. Let's see if we can do something here today to help us all get a little further ahead. That's the goal, right? All right. Who am I? Sometimes I forget to introduce myself. Who am I? Who's Lan Turner? Former instructor at the Chicago Mercantile Exchange Board of Trades Education Centers, currently an instructor at Dixie. Well, we changed the name. It's not Dixie State University anymore. It's now Utah Tech University. So that's who I am. So I teach these classes at the university, and this is the lab for those classes. So all of my students come and we join here, and we do a little trading in the morning after learning the academic side of the financial markets. And so anybody's welcome, of course, not just the students, because this is YouTube. And so we do YouTube live, and everybody can come and watch. And we are here live today, and we're going to watch the markets. And we're going to watch the market open. And that's why we're here at 7:30 in the morning. 7:30 my time here in Mountain Time. 7:30. We like to watch the opening bell for the indexes. Now, we are in the futures market over here. We're looking at the futures market. And the futures market, of course, is traded out of Chicago, not out of New York. Although we are trading the New York indexes. We are trading up here in the upper left-hand corner. We have the S&P 500. In the upper right-hand corner, we have the Dow. Bottom right-hand corner, we have the NASDAQ. And bottom left-hand corner, we have the Russell. Lan, why don't you trade something besides the indexes? Well, we do. Well, I trade a lot of things. The reason we look at the indexes is because they have an opening bell out of New York. And Chicago doesn't have an opening bell. It trades basically 23 hours a day. We close it down for an hour, do a little mark on the market, do our accounting, and then we open it right back up again. So these are some basically 24-hour markets, and they open up on Sunday evening and they close on Friday afternoon. And so they run all the time. But because they have a 24-hour market, they have an opening bell because New York closes down. And so these are the four indexes that trade out of New York, and they have an opening bell, and it comes up at 7:30. And then these markets take off and run like ponies. And so we like to watch the opening gate, and we like to watch those. And that's what's fun about this market. So we come and watch the morning bell and see if we can't catch some of this excitement that's going on in the financial markets out of New York. But we trade it out of Chicago. Why do you trade it out of Chicago, Lan? We trade it because there's no pattern day trading rules. We can start with a very small account. We can get our feet wet. We can start with micro mini accounts if we'd like to. Little small accounts where it's not very much leverage, and we don't have to have those $25,000 accounts to start with. Just get our feet wet and learn. So these are some great markets for people who would like to do this, learn how to trade, build their accounts up. And then what people find is that, they want to continue to day trade. They don't ever go back over to New York and day trade because they learn that it's so much more fun here in Chicago. That's why we're here in Chicago. All right, so the morning bell is going to get ready to ring here in about, 40 seconds left to the bell. So this is what's happening in the markets. Let's bring this thing up full screen. There we go. And market's going to ring here. The bell's going to ring in 26 seconds. So what do we got going here? Up in the upper left-hand corner, we have the S&P 500. You can see the S&P ran really hard. Let's bring this full screen here just for a second. Look at this morning. It took off like a rocket ship at 4 a.m. and drove higher all the way up. And remember, this is a leveraged market. So that market moved $3,662. You're like, yeah, $3,662. That's a big gain, Lan. How much was the investment to make that amount of money? $1,000. What? $1,000 turned into $3,662 in the futures market, trading the S&P 500? That's unbelievable. I don't believe you, Lan. It's true. It's true. It's very true. You can look at that over here in the key. Look at the key. The key will tell you. Day margin on peak, $750. I always just figure that's about $100. Those can change. 750 is what it's listed as right now. Off peak is 3,245. Now, this might have been considered off peak, so it might have been 3,245 to make that 3,662. All right, because the on peak is when the bell rings. So, well, it tells you right here when on peak is 6:45 a.m. to 2:30 p.m. All right, so the morning bell is opened. I know I'm over here on a 15-minute chart. That was a 15-minute chart. That's why the the way it was. We need to go look at that again because I was not recognizing that was a 15-minute chart. So that was yesterday's market. Was it? Yes, that was yesterday's market. So what are we doing today then? We had a big rally yesterday. So that's a 15-minute chart. Sorry, I apologize. I was looking at that as if that was the morning bell, but it was not. That was yesterday's move. Massive move yesterday. We had a short position. Remember, it was a put. I'm going to tell you what happened to our put yesterday. We bought a put and the market went to the moon. That was a crazy move, Lan. Why would you do something like that? Well, because we did. So now we're going to look at this market. This flushing down. Look at it flush down on the Dow. This is the coming out of the opening gate. And then they've got the Russell over here. Now, up here in the Dow, this is a 1-minute chart. Okay, so we got a few different things going on here. And we're learning. Remember, this is a learning environment. And so we're doing different things. We're practicing. We do a lot of stuff here. All right, we trade a lot in here. Do a lot of crazy things. And we're trying to do it because we're all learning, right? We're trying to learn how this stuff works. And it's better if we do it here together and do a lot of trading. When you do your own trading, I wouldn't imagine you trade nearly this much. I mean, I'm doing a lot of crazy stuff, so be careful. And I don't expect you to do all the crazy stuff I do in here. Kind of calm yourself, take a little bit slower, be a little bit more careful. We're a little bit more rambunctious in here because we're learning, right? We're in a learning environment. So we do a lot of things to try and see what happens when that happens. When we do this, what does this do? When we do that, what does that do? All right, there's a lot of that going on in this course. So let's come back over here. The first thing I want to say is that I talked to Bruce. Yes, it was Bruce. I talked to Bruce yesterday, and Bruce and I had a great conversation. If you guys would like to have a personal conversation with me, that's certainly possible. You can sign up for my free bull sessions, what I call it. You go to my just go to the track. What website would be best for you to go to? Go over to Trade Mentors, tradementors.com, TRADEMENTORS.com, and you can find my online calendar, and you can sign yourself up, put yourself on my calendar, and I'll call you on the telephone, and you can have a personal, private conversation with me. Bruce called in or set up an appointment. I called him yesterday, and we had a great conversation. Look at this beautiful little Russell down here. Now, this is a range bar 10. So the Dow is a 1-minute chart. The range bar is a range bar 10, meaning that each price bar represents 10 minimum moves. Not time. There's no time involved. So look at this beautiful little ABC pattern right there. So that would have been our little buy signal in here. We had a long, but now it's reversed. So we have our up arrow here. So that means the market is bullish. We have our changeover from red to green. That would be a buy signal. And then the market went up. Now it's changed. So we draw our little trend line under here. And now it went to an arrow down arrow. So now it's in a downtrend. So it doesn't mean it can't turn and rally once again and start going back up. It can. Okay. So we just kind of watch these arrows. If the market's above the arrows, we consider the market bullish. If it's below the arrows, we consider the market bearish. Okay, so if we have a down arrow, we're looking at a bearish market. We have an up arrow, we have a bullish market. And that's how it works. So we're switching over here and we're going back into some green bars. You say, well, Lan, that's a bullish signal. Go long, go long. No, we're still in a down arrow. So that means we're still in a bearish position. Doesn't mean it can't switch. It certainly can. It just did. Well, you'd have been good to go long right there. Yes, that would have been good to go long right there. You can do that if you want to. Go right ahead. You are the trader. I'm just telling you. I'm just teaching you stuff. But you are the trader. You can do whatever you want. I'm just telling you, if the market has a up arrow, we generally want to take red to green moves, like right there. Would have been a good place to get in long on this position because we have an up arrow. We have some red pullback bars, red to green, first green bar, first candle to make a new high. There it is. It's green. Boom. You get in and you ride that thing up. And we do some different strategies. Once we get in, we do some scalps. We can do some trails. We can do some scalp and trails. That's my favorite. I like to do a little combination of both just in case the market wants to take off and go to the moon. I don't want to miss it. Or we can do scalp and scalp. We talked about that yesterday. We could be Mr. David Duty and just do the scalp and scalp. Forget this trailing crap. What the heck is trailing? Why would you trail out to a long, big trend? Why would you? These markets never trend. Oh, wait a second. Sometimes they actually do trend. So if you can catch that, you can make a lot of money. And then you're very happy. One good trade away. Remember what they always say, one good trade away. You're always one good trade away. Okay. But we do need a market that's going to move and shake and trend and trail and give us that opportunity. Right now, the markets just seem a little unpredictable. So we're going to just kind of sit on our hands right now and wait and see what happens. One of the things we do need to do. Did I finish my conversation about going and setting up an appointment with me? Go out to trademiners.com, find my appointment calendar on there, sign up for a free bull session. You and I can have a chat. It's always fun to talk with you guys. I can't talk to you right here. All I can do is talk at you. I can't talk to you. I can only talk at you. So I just sit here in my little office and talk to myself is what it kind of feels like. But I know you're out there listening. Yeah, we got a good group of people today. So we got a nice little audience. It's great to have you guys all here. So thanks for coming and joining me. And hopefully I'll have something for you that you can learn today. We're going to do a lot of stuff today. All right. We got a lot going on. I talked to Bruce, like I mentioned, and he would like me to put on a couple of option strategies. He wants me to show him those straddles and strangles that we were doing a couple weeks ago. He said he was doing some straddles and strangles in his own account, and he was having some good success, but then he had a loser. And so he wants me to just kind of review a little bit how I was able to take those things off, how I put the limit orders on. So we're going to review that today. Okay, we're going to put on both a straddle and a strangle in the S&P. Now the market's falling. Okay, it's coming down on this 15-minute chart. Might be, let's go kind of pop that up. We'll put these option orders on. Just kind of watching this little jump all over the place thing. This is the ponies jumping out of the opening bell. And want to see what's going to happen here real quick. This is the 1-minute chart on the Dow up here in the right-hand corner. NASDAQ, we got the range bar of 50 on the NASDAQ down here, and this is working off of the bulls and bears right now. And we got a moving average on it. I'm using kind of a combination of the bulls and bears moving average in here, kind of a fun little strategy. I'm going to set that up on the autopilot. I wanted to tell you what happened to our put option yesterday and how we ended up with the day. Because when I logged off with you guys, we were down. Remember? We were down like what, $120, I think. And so, but we still had our put option on, and we had mitigated. We'd put a second option on to mitigate with the dollar cost average. I want to tell you how that turned out. But before we do that, I'm going to go put these other options on, and we're going to get our autopilot running on the NASDAQ. And then I want to kind of just manually day trade the Russell just for fun in the Dow. So that's what we like to do. But I want to get these other things going. So let's go ahead and bring up our S&P into the full screen. We're on a 15-minute chart, so realize this is a 15-minute chart. I didn't realize that when I first pulled it up. I was thinking that was the pre-market session, that it ran like that in the pre-market session, but it didn't. That was yesterday's market. So that was yesterday's market, and that's what it did. Man, what a massive move yesterday. So I hate looking at that, because what happened to me, how much did I make yesterday? $42.50. So it's because I had a put option. Lan, why did you put on a put option? Well, come and look at the daily chart. Look at the daily chart. You can see a put option. We were coming down, and I put on, and we had this big, massive. See, we were in a downtrend. Of course, we came down. We touched this red line, which is in this case it's the exponential 28 moving average. And it bounced, started to rally. Well, Lan, does that mean that it's going to go straight to the moon now? Is it going to just turn and go right back up? Well, maybe it could. Market can do anything it wants. All we have to do is play the probabilities. Well, what's the probabilities of that happening? Not very high. Probabilities are more likely. Doesn't mean it can't do it. And this is a daily chart, and this is the S&P 500. And we have had some very good fundamental news come out recently. So it very well could just be the pullback and start to rally once again. And you might want to be long this market. If you want to buy a little call option out there on something, you could do that. But oftentimes we'll come up and make what we call a 1, 2, 3 top formation, or we have a little head and shoulders going on in here. It would be a little ABC pattern where it come up, break, and turn and fall once again. And we oftentimes see this thing come down to a Fibonacci retracement. Now, oftentimes the S&P doesn't make retracements all the way back into the Fibonacci sweet spot. In fact, that would be a relatively large, disastrous move, right, for this market to actually fall back down into the Fibonacci sweet spot. So something negative would have to happen that would cause that market to fall like that in the S&P, because it is the 500 biggest and best, most robust stocks in the entire stock market. So for them to fall that far would be kind of a nasty thing, but it doesn't mean it can't do it. It certainly can, because look at what it did here. Man, well, that's kind of a nasty move, Lan. Yes, it is. And markets move in waves. They have a tendency to do wave patterns, right? 2 steps forward, 1 step back, 2 steps forward, 1 step back. And this market's just gone kind of straight up. This is called a V recovery. It came down like this, and we expected it to come up, pull back, right? Come up, pull back, come up, pull back, something like that. But did it do it? No. It just went, hey, Lan, look at that. I can go straight up. And it did. It went straight up. Well, it had a little bit of a hesitation right in there, but not much of one. And so that was called a V recovery. All right. So you have the drop in the market, and the market just went straight back up. We got lots of good news. And because the market had fallen back, listen to that good English. The market had fallen back to that level there. It had rallied to this level here. It just went straight back up, broke that previous high. That's a crazy market. So it came back down, and it tested that level of that previous level of what we call resistance on the downside and turned it into support. So it became support, and it's starting to rally once again. Is it going to go up and break this previous high? We have new resistance up there, which is that new high. So that's our new resistance point. And we would anticipate the market would go up and test that. So that's what we're looking for. So we are bullish on the market in anticipation of a continuation of the uptrend this week, unless something comes out that could be a negative news event that could cause that market to change its mind and flush and come back down. All right. So we have a lot of craziness going on in the world today. So there's always things that can cause the market to move one direction or the other out of characteristic of what it would normally or naturally do with just typical investing. Okay. So you got to always take into consideration the news. So this looks bullish today. Okay. We had a big bullish day yesterday. It looks like a continuation. We should see a little bit of a bullish day today on this, right? On the daily chart. But when we go down and we look at the 15-minute chart, what's happening? Flush. It's coming back, giving a little bit of this reprieve from the yesterday's big massive move. So we had yesterday's big massive move. It's coming back down. Lan, how far is it going to come back down? Well, nobody knows. But we do have measuring tools that we can measure, and we can say, well, markets have a tendency to come back down into the Fibonacci sweet spot. And I just knocked off that tail. And you're going, Lan, why'd you knock off that tail? Well, because it was spring, but we'll take it into consideration. Okay, so we're going to go in here. We're going to drop this in just like that. So we have a Fibonacci ruler goes from bottom to top. Okay, so we can measure from bottom to top. You'll notice this thing's coming right back down and touching that Fibonacci 38.2 right now. So it's bouncing off of that level, using it as an area of support. And so you're like, well, Lan, I know what you're doing. You draw enough lines on the chart, eventually the market will touch one, and you can say that your system worked. That's very true. Hey, wait a second. You just took that from me. That's my saying. Okay, well, I'll let you steal it. If you draw enough lines on the chart, eventually the market will hit one, and you can say your system worked. Well, that's why with Fibonacci, we have very few lines. All right. We don't use a lot of lines in Fibonacci because of that exact reason why, you see guys draw lines all over the chart. And then when the market hits one, they say, see, my system worked. But the question is, would you have actually put money on that? You have 42,000 lines on the screen. Which one of those are you going to actually use to buy or sell the market? So these lines are very particular. 38.2, 61.8, and 50. These are some big, very important numbers to the industry, to the market, all right? Why do they work? Why do markets come back to that? Well, because we have a Fibonacci ruler. Is it putting the cart before the horse before the cart, or is the dog wagging the tail, or is the tail wagging the dog? Who knows? We don't know. Oftentimes, a lot of this technical analysis stuff, we all use it, and so we make it happen. It's kind of like self-fulfilling prophecy. But if it works, heck, we don't care why. It just does. So we have a lot of times where we have the market will come down and test these levels of support. If it can break through that 38.2, it'll come to 50%. And then if it can break 50%, it comes down to 61.8. Now, if 61.8 is actually a mathematical model, that's our golden ratio, and that's why that's an important number. You can say I've made it red. Red means it's important. Okay, so that's an important number. It's red. Green is our first one. It's kind of coming in there with our bulls and bears, red, yellow, and green. We got 50% is yellow. We're going to anticipate this market coming down here somewhere around the 50% level maybe even as far as 61.8 before it turns and starts to rally once again. All right, so that's what we look for. This is called the Fibonacci sweet spot. Of course, yes, that's my name. I don't have heard anybody else call it that, but I'm the one who calls it that. So let's all call it that. Make it famous. All right, the Fibonacci sweet spot right here between 38.2 and 61.8, because this isn't engineering. I mean, we're not building buildings here. Okay, we're building markets, and so markets are fickle and they do all kinds of crazy things. So we're not going to say that a market has to come down and touch 61.8 before I'm going to take advantage of this market and get in long. We're going to just look for it to come down somewhere in this region. All right, this region is an important region to the market. It doesn't have to be exact, just somewhere down in here. Once it turns and starts to rally once again, we start getting green bars to the upside. That would be a great place to start looking for this market to rally and go back up. So these are profit takers driving this market down, and we got some short sellers in here coming in here pushing that market down. All right, does that help? That's a little technical analysis lesson on Fibonacci and how Fibonacci works. All right, so let's delete all those circles. Let's delete all these lines. And we want to put on our options order. So it's falling right now. So let's kind of give it, let's not put on our options right now. Let's try and be a little bit more strategic about when we put these options on. Usually what we do is we just come in and we slap them on here just because, well, you know, we want to know how to put them on. We're not really trying to time the market. We're just putting them on whenever. This time, let's kind of try and time the market. So let's wait until this market comes down. See if it wants to touch that 50% level. That would be a great place to put on these neutral market strategies, because we're going to put on a straddle and a strangle, which are both neutral. Not really neutral, because we're not taking advantage. We're not selling them. We're going to buy them. So we're going to take and buy these options in anticipation of a big move in the market today. Now, is there the possibility of a big move in the market today? Well, yesterday there was a big move in the market. You know, we're getting a little active. We are in the January time frame. The first quarter of the year is generally a very good time to be trading. So we want to be mindful of that and take advantage of that. We've also got some news coming up, and today we've got the Fed Bar speech. So good old Fed Bar is going to go out there and he's going to speech at 10 o'clock. He's going to speech. So at 10 a.m., we got good old Fed Bar going to try and move the market a little bit. We got a couple of guys out here in the market. Let's let's go say hi to some people. So we got just a second while we're waiting for that market to decide what it wants to do. Let's say some hellos. There's Bruce. How you doing, Bruce? We're going to put on those straddles and strangles for you today. All right, there's Gary Thomas. Nice to see you, Gary. Great to have some of you guys in here, some of you old stalwarts that like to come and hang out with me, hang out with each other too. It's great to see you. John David Lundberg, great to have you. We've also got Larry McIntosh. Great to see you, Larry. And we've got Camille. Camille, good morning. Nice to see you, Camille. We got Matt Baker in the house. Nice to see you, Matt. Good old stalwart. I know you like to trade that Russell. You got any trades off today? How's it going? You making any trades, Matt? How about Michael Bruce? Oh, Michael Bruce. I love that picture you got in there, Michael Bruce. That's a beautiful little bowl, the golden calf. All right. We got Kirk Schwartz in the house. Nice to see you, Kirk. We got W.N. Crandy. Good morning. Owens RV Marine. Nice to see you, W.N. Crandy. Great to have you in class. Hope you learned something today. We got Ben Corpus. Glad to have you, Ben. And we got Claude Elbaz. Excellent. Stay on the ES. Wants to watch us trade the S&P 500. Well, we're going to do a little S&P trading today. We're going to put some options on it. All right. So Claude says, just discovered your videos. Great. Wonderful. Great to have you. Cheers. It's always great to have new people show up and come in and join us. Please come and stay. Come back again tomorrow and the next day and the next day. And we're just going to keep doing more and more and more of this. All right. So we're going to watch some of this stuff. We're kind of watching this thing bounce around this 38.2 right now. We got to just looking for an opportunity to put on our straddles and our strangles. All we need is the market to move. We just need it to kind of decide that it wants to. We could put one on right now just to kind of get it going, but let's kill that one. Let's look and see what's been going on down here on the Russell. This is the Russell 10. So Matt, I put this on Russell 10. It's not on the 1 minute chart. We're watching the Dow on the 1 minute chart. We're watching the NASDAQ on the range 50. Now remember, range 50 means that's 50 minimum moves before it's going to give you new price bars. Does not have time involved. There's no time involved. It could take 10 minutes for one bar. It could take 10 seconds for the next one. It's just how far the market has to go before it'll give you a new bar. And that's 10, in this case, range 50 ticks. All right. So In this case, Lan, how do you turn on those range bars? I've got track and trade and I don't know how to turn on the range bars. Well, there's a couple of things you have to know about that. Let's go in and do a little lesson here. We're going to open up this. We'll do it on the Russell. All right. So we're going to come in here to the Russell. You have to bring it full screen. And then down here in the left-hand corner, you can see all your little tabs. You can see all your trading tabs down here. These are your different time frames. So you can change the market in several ways in track and trade. There's always multiple ways to do things in track and trade. So you don't have to stick with just one. It just gives you shortcuts in case you're in a situation where you don't see the tabs. For example, in the mini mode like this, there are no tabs. So you have to bring it to full screen. We get the tabs down there. And then this is where you change your time frame. So right now we're looking at a range bar 10. I've also got range bar 8 in here. Now that's a range bar. You're like, what the heck, Len? That is ugly. Well, go back to the 10. Oh, yeah, that's nicer on my eyes. Well, that's because this is a range bar 10. This is a range bar 8. And in the range bar 10, I have Heikin-Ashi applied, right? This is no Heikin-Ashi. This is just a range bar. This is what most people see when they look at range bars. Now, remember, I called up the programmers. I said, hey, put me some Heikin-Ashi bars on those range bars. They said, I don't know if I can do that. I said, well, give it a shot. You don't know till you try. And they said, well, all right, well, let me give that a shot and I'll get back to you. The next day they came in and they said, hit that HA button. So I did, and boom, we put some Heikin-Ashi bars right there on those range bars. And that really just changed my world. Holy cow, what a beautiful chart that becomes. Now, I can't say that the Russell's doing a lot today. It's being a little lazy and dead. So unfortunately, we're not getting a lot out of it. So we have to kind of just take that into consideration as well. Heikin-Ashi bars, even though they make the chart look beautiful and wonderful, they can't make the market move for us and trend. All right, so this is the 1 minute chart that you can see down here. This is the 2 minute chart, and you can see I can go back and forth between those. Those are different charts, so they're not the same chart, they're different charts. So it's a 1 minute chart of the Russell. This is a 2 minute chart of the Russell. And actually, I'm changing that chart. I apologize. That is actually the same chart. So now I'm making it a 15-minute chart. But the 2 minute chart doesn't have Heikin-Ashi turned on. So if I wanted, I have to turn it on. There it is. Now we got Heikin-Ashi on the 2 minute chart. So this is a 2 minute chart. It is not a range bar chart. We go back here. This is the 1 minute chart. It again is not the range bar chart, but it does have Heikin-Ashi. We can turn that off on the 1 minute chart. There we go. And then you come back here to the range 50 chart. And it's going to have to load. But there it goes. There's the range bar 50 chart. And look at that baby. It's got open, high, low, close bars. You're like, Lan, that doesn't look like the others. Okay, well, make it look like the others. Come in here and say price, bars, candles. There we go. There's our 50 range bar. No Heikin-Ashi. Let's turn on the Heikin-Ashi on the 50 range bar. Okay, let's do that. Boom. There it is. Beautiful 50. And there you go. Now you've got yourself a range bar 50 chart with Heikin-Ashi bars. All right. Now, why would you want to do that? Well, we're doing it because David Duty does it. David Duty? Who the hell's David Duty? David Duty's a buddy of mine. He and I have been trading together for about 30 years. He and I are pals. And so he likes to use the range bar 50 for some reason. And he scalps out of the range bar 50. So he's scalp and scalps. Scalp and scalp. He doesn't do scalp and trail. He does scalp and scalp. I like to do scalp and trail. Lan, why do you like to do scalp and trail while David Duty does scalp and scalp? Well, because how many times have I seen David Duty get into a situation like this right here, and he scalps out $100 and he's done, but yet the market moves another $785. And he doesn't catch that because he scalp and scalps. So I said, well, David, why don't we scalp and trail? We get in, we scalp one out. So we get in with a couple. We get in with 2. Let's get in 4. Let's get in with 6. Let's get in with 8. However you want to do it. Let's say 2. So you get in with 2. You take one off at a scalp. Let's say $100. David Duty on the NASDAQ likes to do 22 ticks. All right. So he scalps out 22 ticks. That's $110. It covers his commissions and fees and gives him $100. So he'll do that. And then I say, well, why don't we take the second one? And instead of scalping out 100, let's let the market trail behind it and see how far it wants to go. And sometimes we're going to catch a big, long trend, and we're going to make thousands of dollars. And David says, that's a great idea, Lan. Go do that. And I said, okay, I'm going to go do that. So that's the scalp and trail strategy. All right. But this is the Russell. range bar 50. On the Russell, I like it to come back down here. We're going to go back down to the range bar 10. We tried to do the range bar 6 yesterday, if you remember, and the market was going a little bit too fast for range bar 6. Kind of couldn't keep up with it. So I slowed it down, put down to range bar 10, and we're going to be looking at range bar 10. What, Lan? What do you mean? You don't know all the answers? No, I'm just trying shit out, just like you guys should do. The thing is, we just do it together and then it's more fun, right? You can sit here and do all this stuff on your own, but if we do it together here on the YouTubes, then we can all do it together and it's a lot more fun. Try stuff. That's what we do. That's how we learn, right? That's what this class is all about. I've been doing it for 30 years, so yeah, maybe I'm a day or two ahead of you, but still, new features in the software, we all have to learn them together, right? So let's come in and see how we're doing. So let's come back and we're going to go back over, and I was going to show you how to change those, get those range bars in there. So we get this up here on this chart here like this, and then we come down here to these things here down here, these, what do you call them? Tabs. So you come down here to these tabs and right click. On your mouse, you got two buttons. You got one on the left side, you got one on the right side. If you click the one on the right side, you all know that. That's called the right click button. So if you right click on lots of things in track and trade, you can get lots of stuff all over the place. So go and right click on everything, because most people don't think about right clicking. They only think about left clicking. But in track and trade, there's all kinds of things that you can do if you right click on them. So right click on those tabs. And what that does, it pulls up a little window like this, where you can come in and set whether you want it to be a range bar, whether you want it to be a volume bar, a bid ask bar, time bar, minute bar, whatever you want. And then in these windows right here, you can set up the time, however much time you want it to be. All right. Oh, I want this one to be a 1 minute bar. I want this one to be a range bar 8. Oh, I want this one to be a range bar 10. Lan, why don't you make this one range bar 8 and this one range bar 10? Okay, well, let's do that then. Then we go from 1 minute to 2 minute to 15 minute to range bar 50. I put that up here at the end. So we're going to go ahead and we're going to hit apply that. And we changed all of our bars back. Okay, so this is now a range bar 8. We're going to bring it back to our range bar 10 and it reset it. Okay, so to the factory default. So now I come in here and tell it it's a candle and turn on our hike and ashies. Oh, turn our ashies on, and there we go. We're back to normal. Okay, there's our range bar 10 on the Russell. Just like that. Now over here in the right hand menu, we can now right click and we're going to have all those settings again. Did you see that? I right clicked on the header. And the right click gives me all the choices of which charts I want to open. So now I can open up all these charts over here. I got my range bar 8, I got my range bar 10, my 1 minute, 2 minute, 15 minute, and my range bar 50. I've also got daily charts, weekly charts, monthly charts, and I've got to open up all the charts. If I hit that one right there, it's going to go and open up all those charts, but I don't want to do that right now. Okay, and we can also delete all the charts, delete all the Russell charts by clicking that one. I don't want to do that right now either. But what if I want to see two different charts on the Russell? Well, you can do that. We can come in here and we right click on the header, and I've already got a range bar 10 open. So I can open up let's say a 15-minute chart. So now I have a 15-minute chart and a range bar 10 on the Russell. Now these are two separate charts. So if I come in here and draw a circle on the 15-minute Russell, I can come back over here to the range bar 10 and you'll notice there ain't no circle. Why ain't there no circle there? Because the circle is drawn on the 15-minute chart, which is over here. It's a different chart than the range bar 10 chart. So I can come over here and I can draw a square. So now I got a square on that chart and I got a circle on this chart. And those are two separate charts, even though they're both the Russell. I know, confusing, but not really. It's very cool, in fact. But Lan, what if I want to just change this 15-minute chart that's got the circle on it down to a 5-minute chart? Well, you can do that by right-clicking, once again, right-clicking on the chart itself, not on the header, because if you click on the header, that's going to open a new chart. See how it says open? But if we come down here and we click on this 15-minute chart, we can now change it to well, we didn't have 5-minute chart in there. We put a 2-minute. So let's change it to a 2-minute chart. So if I change it to a 2-minute chart, it's the same chart, and we still got that great big old giant circle that we drew on the 15-minute chart, because I changed the 15-minute chart to be a 2-minute chart. See how that works? So that's confusing to you just a little bit. You're going to have to practice with it a little bit, but now that you've practiced with it a little bit and understand how the concept works, you could do that yourself. Okay, let's bring this one back to, well, we don't really need that one. We're going to go ahead and delete that chart. Now we're back to our range bar 10. We're going to go ahead and kill that. And look at this market started to run a little bit. So doing well here. We've got a nice little ABC occurring in here. ABC, there you go. ABC, Lan, ABC. Heading back. Where's it going? It's going back to the magic blue rubber band line, right? Looks like it wants to go up and touch that VWAP. Okay, so that VWAP, that's our rubber band. Let's go back over and take a look at our S&P. How's that thing? Oh, it's bouncing right now off that 38.2. Let's go ahead and put our options in, shall we? Okay, we're going to come over to the options tab. Hold on one second. I got to drink some tea. We got some more people saying good morning over here. Let's say good morning to some other people. Let's see. Where did we get to? We got Trading Research back in the house. Nice to have you, buddy. Good to have you come along. Haven't seen you over here for a while. So, well, I've been on vacation. Maybe that's why. It's great to see you. Glad to have you. We got Uncle Benny's Creepy Campfire Stories. Great to have you, Uncle Benny. We've also got, oh, there's back to Claude saying hello, Claude. So we'll say to you, hi to you, Claude, one more time. Claude saying VWAP 4780 on the ES. So are we on the ES? Yes, we are. So let's come and look. What chart are you looking at there? Claude, are you looking at the 1 minute chart to see where that VWAP's at? Oh, let's see. I don't have VWAP on. Let's turn on. Let's get rid of this and come in here. Chart overlay VWAP. So VWAP, coming back to the VWAP on the 1 minute S&P. Let's go back and put that on the 15 minute. There's the VWAP. Oh, we have the VWAP. That's a blue line on there. All right. So that's where we're at, Claude. Oh, Claude's looking at the 5 minute for that VWAP. That's what we're looking at. Maybe that market will come back to the VWAP, right? So let's come in and put on our options. Let's go in. I'm going to show you how to do that. We're going to put on, it's not something you might generally do, but maybe. I don't know. I don't know what you're going to do, you crazy traders. You can do all kinds of funny things. I'm just going to show you how. All right, let's come in here and I'm going to show you how to put on a 0 DTE. We're going to pick 0 days till expiration. It means that we've only got 1 day for it to make money. If we want one or 0 days, sorry, it's going to expire today. So if we want 1 day, want it to expire tomorrow, we'd put on 1 day DTE. We could put on 2 days till expiration. We could put on 3 days. When is Friday? The 12th. So if we went to the 12th, January, we would have to go 4 days, 3 days out. That would be expiring on Friday. So if we did that one, that would expire on Friday. So you could do that. Why not? Heck, you can do whatever the heck you want. You can even put it on to expire on Friday and still take it off today. You can do whatever you want, right? There's no right or wrong answer. It's just which one you think is going to make you money. You can put it on with more time. Of course, it's going to cost you more money. This call option at the money is $1,212 with 3 days until expiration. Well, how much does it cost to buy one with 0 days to expiration? $407. Well, that kind of makes sense. It's basically 4 times 3, right? But a little bit. 4 times 3 is a little bit more than 1,200. That saves you a couple $100, right? To buy a little bit more time. But it depends on what you want to do. Well, it's more money, man. It's more money, but it's more time for the amount of money. Amount of money for the more time. Get it? So that's how it works. So let's just get and do a 0 DT. It's going to expire today. We're going to put on $400. That's a $400 at the money. So what we're going to do is we're going to come over here, and there's different ways we can look at this. We can look at this the traditional way, where the strikes are down the middle and then all the information is out the sides. That's a little confusing to me because they're all jumbled up. It's like, well, then Lan, why don't you have the programmers fix that so they're not all jumbled up? Well, because it's called traditional for a reason. It's called traditional because that's how some dude did it back in the 1800s. And you know what? In the futures and in the stock market, we don't change shit. If somebody did it like that in 1810, we still do it like that today. A lot of that kind of stuff going on. I'm not kidding with you. Look at those symbols on there. ESH24. What the heck does that mean? Well, that's an acronym, a very shorthand for the ES, which stands for the S&P 500. Why does E stand for the S&P? Well, because it's the electronic market version. Aren't they all electronic market versions? Well, they are today, but they didn't used to be. So we have to put E in there. E for electronic. SH, this is for the S&P 500. H, what the heck does H stand for, Lan? In that symbol for the E mini S&P H24. Well, I think Back in the old 1800s, when you had those ticker tapes come across there, they used the letter H to stand for March. What? H for March? I know. I mean, I don't know. I don't know. I don't know. They did stuff like that in the 1800s. And we just don't change them nowadays, even though we have computers and we have big, long screens with lots of room. We didn't have to use that acronym anymore if we didn't want to, but we still do. Why? We hate change. We just do it. Z stands for December, just so you know. The Z stands for December. Yeah, I know. ESH stands for the E-mini S&P. H, which stands for March. The March contract expires in March. 24 means that it ends in 2024. Well, what if 24 means it ends in 1924 land and you have the 2000 bug? Yeah, we had to fight with that at that point. Remember the old Y2K? Oh no, what's going to happen when everybody used 24 and 24 meant 1924 and not 2024 and all the computers died and we were all going to be the end of the world. Remember that? So yeah, things like that. So anyway, we're on the E-mini S&P, the March contract, which is the H, and then the year 24. So that's what we're doing. So now the reason, back to what we were doing, traditional view, all skiwampus, because that's how they did it in the olden days. So we're just going to have that. But we have other ways of looking at them. So we can just look at the calls a little bit more, makes a little bit more sense. You can right click on the header, column setup. You can change all kinds of stuff in here. Make your columns as big and long as you want, however big of a monitor you have, whatever information you think is important. We have just the puts in here. We have both calls and puts. They're intertwined. We have in the money puts and in the money calls, and we have out of the money calls and out of the money puts. What the heck is an in the money and out of the money option, Lan? Not glad you asked. Glad you asked, but I'm not glad you asked because I'm not going to tell you the difference because that's beyond the scope of today's lesson. You should already know that to be doing what I'm doing. And if you don't know that, come back because we'll talk about that another time or join my class down at the university. I can't come and join your class. I am, let's say you're Michael Bruce and you can't come to my class in Utah because Michael Bruce is living on some island out in the Atlantic Ocean. So what is Michael Bruce going to do? You're just going to keep coming, Michael Bruce, because I'm going to teach you that. I'm just not going to teach it to you right now. All right. Or you can go to tradementors.com and you can sign up for my course and it'll teach you in there. But I will teach you that. Just I can't do it today because I'm already running behind schedule. I'm talking too much. So let's go ahead and put on our orders. We're going to put on an at the money straddle, at the money strangle, I mean. And remember, straddles and strangles. Straddles, what is a straddle? And we're going to put one on so you can see. So we're going to come in here. And how am I going to do this? Just kind of think. There's lots of ways we can put it on. I'm just going to come in here and we're going to buy a call at the money. And look at the in track and trade. I can just drag and drop that on the screen. I don't have to do it down here in the control panel window. I can come in here and just go, I'm going to buy a call at the money. And I'm going to buy a put at the money. Okay, so at the money, of course, means right at the current market price. And it is on top of each other, 0 days till expiration. So that is going to be called a straddle. I know, it's backwards. It should be a strangle. But back in the 1800s, they didn't know the difference between straddle and strangle. So they got them confused and mixed them up. So we're going to put on a straddle, and that means they're both right on top of each other. All right. And I'm going to do this in separate orders. Okay. Actually, I'm not going to do the straddle and strangle at the same time. I'm going to put on this. We're going to put that on. Okay. Let's just go ahead. We're going to market order into that. We got that order on there. All right. I know it took a long time to make that happen. Okay. So we got our first order in there. This is our call and our put. So we make money if the market goes up on the call. We make money if the market goes down on the put. The put, if the market goes up, the call will make money and the put will lose money. And you're like, well, what good is that? It's not going to do us any good. Well, the put can only lose $395. It's the max it can lose, right? But the call has unlimited profit potential. So this thing turns and goes to the moon. Hey, it can make more than we lose. That's the name of the game, right? So it does require time, but we only have 1 day. So this is day trading. So it's only got 1 day. Let's go ahead and put on our strangle. Why this market's got a little pumping and dumping going. Let's see, we're going to buy that one and we're going to buy this one. So again, we're going to buy a call and we're going to buy a put. And we're going to put them just an equal distance apart. And and actually, I'm going to do this. I'm going to cancel that. I'm going to buy my call up there. Let's go ahead and put that in. Now I put it in all by itself. So I put it in all by itself. And so it's out there all lonely, right? So let's put on a put option to make this thing go both sides. So now we've got our put option. We're going to go ahead. We'll just put that in with the market order and away we go. So now we've got a straddle and a strangle. Now, would you do this yourself with real money if you were going to be trading, put on a straddle and a strangle? Possibly. I mean, there's no reason not to if this was what you want to do. And that's why we're going to do them both, right? And so we're going to put them on. We're going to see how things turn out for us. But you could do a straddle and a strangle. But we've talked about in past videos how to do your break-even point where the market has to actually move to become a break-even. And again, not going to do that right now in the interest of time. We're not going to do our break-evens on these right now. We're going to, it's not hard. You can go back and look in previous videos, or you can go buy my course. Not that I'm trying to pitch my course, because you can come and join me here and I will eventually get to that. We will do that again someday when we're talking more about options. Now, how this class works is because this is the lab for my university classes, and I teach different modules, right? I teach trading, I teach investing, and then I teach day trading, and then I teach options, and then I teach, so I got a series of classes that I teach at the university. And as we go through those classes, we go into those things in greater detail. So options, I've already taught the options class. If you want to go back in time and look, they're all posted on YouTube. You can go back and look at those options classes and where you go into great detail in some of this stuff during that options class time frame. So what we're doing now is, well, we've already done that, right? So a lot of the students in here already know all that stuff. So we're just going to put them on and practice and put them on and not do all the the academic side of this, because, hey, we know what's going on. We've already done all that academic side. If you're just joining us new, like Claude is, Claude's like, I don't get it. Well, stick around, Claude. We're going to do this over and over and over and over again. Just takes time. If you want to trade options, you got to learn them, and they just take a little bit of time. And today's your first day in class and you're just overwhelmed. Don't run away. Don't go hide. Come back and join us and just keep doing it over and over and over again. And eventually it'll start to all click and make sense. And of course, you can ask questions. That's what this little thing over here on the side window is for. So you can ask me questions. All right. And we'll try and answer your questions and get some things done here. All right, let's get those. I just want to get those going. Now, one of the things, the reason I put those on independently is because I want to come down here into our positions in the accounting window. And I want you to see that we've noticed that the one that we put on the same ticket, this is a multi-order option strategy, right? So these are all multi-order option strategies. But this one here, the straddle, which is the one that sits right on top of each other, the straddle is both those options are on the same ticket. So we can see them combined. We're losing 55 on one. We're making 52 on the other. Therefore, we have a loss right now of $2. Okay. So you can see those all calculated together. But the other two, you'll notice I purposely did not put them on the same ticket. I put them on separate tickets. So they're sitting out here independent. You can see that we bought the call and we bought the put. The call is losing $7.50. The put is losing $10. But what if I wanted to see those on the same ticket, but I didn't put them in on the same ticket? And I want to see them on the same ticket so I can see a total profit and loss based on the two combined without having to do the math myself. And then I want to be able to liquidate them both at the same time once it hits a profitable level. Well, we can put them on the same ticket. And here's how you do that. All right. We're going to right click on one or the other. Doesn't matter. Buy the call or buy the put. They're just in one of these two independent ones that are hanging out here. We're going to put them on the same ticket. We're going to do that by right clicking. Once again, Track and Trade has lots of right click buttons. So we click on the right click, and we have a little menu here that says liquidate the option, roll the option, manually link the option, retrade a single option. So you can retrade, meaning you can add to it. If it's got one, you can come in here. Hey, I want 5 of those now. Click that, boom, it'll put them in there. You can then have 5 of them, right? So what we want to do is we want to right click on that, come down here and manually link the multi-legs. So we're going to click on that. It's going to open up this little window, and you'll notice that we got all the options that are available to us to link together. Well, we want to link these two. Which two do we want to link? We want to link the two that are not linked. We want to link the 287254563. So 6563. So we got that. Oh, that's the one we clicked on. So it's already added. Well, that makes sense. The next one is 652. So we have to find 652. We click on it. We add it to the single leg. Now we have our two outer wings out here, the two outers that were sitting out there all by themselves. And we're going to apply and close. And you'll notice that it draws a line between them. Now it drew a line down to the ones in the middle, but that's only because they're because they're in this. We put them on at the same time within the same 15 minutes. If we'd have waited a second, the line would be over here. But nonetheless, we put them all. So we got two on the same ticket and two or more on the same ticket. Lan, could you have put all four on the same ticket? Yes, you could have. But for this strategy, we don't want them all four on the same ticket. We want to see them as two independents, a straddle and a strangle. And the straddle is on one ticket, the strangle is on the other ticket, and we can see the difference between the two. You'll notice that remember they're backwards, so I always get them backwards. The straddle is already making $20. The strangle is at break even, $2. All right, so we're making $20 on the straddle, on our straddle. The straddle is the one where they're two both on top of each other. So now, oh my goodness, you can't see this stupid thing's in the way. Let's move me out of the way. How's that? There, now you can see down here. My goodness sake, sometimes I need to go and look at the screen a little bit more often. I am asking why options. Claude is asking a good question here. He's saying that the market is now above the VWAP. Yep, it is above the VWAP. So it started to rally out of here. Came down and touched that Fibonacci 38.2, turned and started to rally. Let's see. Do we have any news that's going on that's affecting this right now too? Because the market's moving. Let's see what the news is saying. What time is it? 8 o'clock. Did we have any 8 o'clock news? We did. We had the economic optimism index. So that came in here. The consensus, the forecast was 41. Consensus was 42. The previous was 40, and the actual was 44.7. Wow. Optimism is high. That's good. Went up. Well, you would think that would mean that people would think the market would go up. So, and sure enough, optimism is high. The market's taken off. All right. Would we have been doing better if we'd have just bought a call? Yeah. We'd be up $197 instead of $32. But that's the difference between one or the other. If you don't know which direction the markets go, that's why you put on both. If you think you know the direction, then it doesn't make sense to put on the losing side, right? That's why in the past week, we were just putting on one, because we went through this process once already, right? Where we were putting on our calls and our puts, and we're like, well, we make $20, but one of those options always makes about $1,000, and we end up making $100 or $50 or something because we had to pay for the loser. What if we just bought the call? Okay, let's try that. And that's what we were trying. That's why we just had a call yesterday. We didn't have the straddle or the strangle, because we kept looking at these straddles and strangles we were putting on and saying, well, if we'd have just been able to pick the market's direction, we'd have made a whole hell of a lot more money. Okay, but then you have to pick the market's direction. So we were trying that, right? That's what we were trying. We were just going to put them on and watch them and see what happened. And so that's why we were doing single long calls or single long puts. And that's why we were doing that. And then I was showing you how to mitigate them if you're wrong. Okay. So you notice that down here in this accounting window, we're up $40 on our straddle, and we're up $10 on our strangle. But you'll notice that one option, the long call, is up $210, but we're losing $170 on the put. That's why we're only up $22. You're like, well, man, that sucks. It is what it is. All right. That's a straddle. That's a strangle. That's how they work. And so you're saying, well, I want to take these off when I hit a certain profit level. So let's do that. Let's come in. And the reason I wanted to put these on the same ticket is so that I could take them off on the same ticket at the same time. When combined together, they either made a profit or lost a profit, at a certain level. I want to take them off when they make a certain amount of money. So we're going to come in here and we're going to set that up. And we're going to let's do the one that's making money now. It's up $22. So we're going to right click on the straddle and we're going to say liquidate the multi-leg. Again, it's the right click menu. Right click on that straddle, liquidate multi-leg. It brings those two into the ticket over here on the right hand side. See that? You got both of them in there on the ticket, the multi-leg ticket, and it shows you the bid, shows you the mid, shows you the ask. And then this is where you bid for it right here. And then we have a little calculator down here. And this little calculator is really super cool. All right. It's really super cool. I have to tell you it's super cool because if I didn't tell you, you wouldn't know it was really super cool. It is really super cool because what it tells you is it says it's going to receive $872. Like, why am I going to receive $872? I want to receive $872. That's pretty awesome. Well, you gave them more than that. Actually, not more than that. You gave them about that. So they're just going to give you back what you gave them, right? You had to buy this thing. And so they're going to give it back to you. And they're also going to give you back the profit, which is in this case, at this point, $37. It's telling you if it closed it out at 17.45, you would make $37.50, or in this case, 4.49%. All right. So we're going to change these little numbers here with these little flipper uppers and downers. And we're going to come in here, we're going to make that profit. We're going to say, well, I want to make about 5% on this trade. So you can run that up until it says 5%. And if you wanted to make 5% on your strategy, you would then say, okay, that would be $42.50. I'm happy with 5%. Lan, I'm not happy with 5%. I want to make more than 5%. Okay, well, run it up a little higher. Run it up to 10%. 6, 7, 8, 9, 10. And there's 10. Net profit, 10%. That would be $85. So when that baby hits $85 in profit, boom, it would automatically take it off and give you your 10%. Lan, I want to make more than 10%. I don't want to only make $85 on my $920 investment. Okay, run it up a little bit more. Let's go up to, there's 15%. Oh, too far. 15%. That's about as close as we can get it right there. 15.27. That'd be $127.50. It'd be 15% on our Straddle and Strangle. So if it hits $127 or 15%, boom, it would take it off and give you your money. Oh, now I'm starting to get a little worried. 127, it's only up $15. It would have to move quite significantly to get that high. Maybe I don't want to take that bigger risk. It might not pay off. All right, we'll bring it back down again. So we're going to bring it back down. We'll bring it back down to, let's bring it back down to 15%. Now, I'm not telling you what's the right answer here. We've got that in other lessons where we can talk about how much money you want to make, what's your risk versus reward ratios, how much you want to risk against your account, all that kind of fun stuff, right? We talk about that stuff. So stick around. We'll talk about that stuff, and you can apply that to this. Oh, I went a little bit far. I want to put that at 15%. I'm going the wrong direction. Lan, get it together. Okay. Did we say 15% was too much? We did. We want to go down to 10%. So we got to run that until our little calculator says 10%. I think Lan is perfect. Lan's not perfect. He has to play with this stuff too. All right. So we got net loss. Oh, I don't want a net loss. That would be a loss of $85. What in the heck are you doing, Lan? Make that a profit. Oh, okay. We'll go the other direction with it then. Make sure you got it as a profit. It says right now it's a net loss. We don't want to take this off at a net loss. We want to take it off at a net profit. Let's go back up to 15% on that net profit. So we're 8, 9, 10, 11, 12, 13, 14. There's 15. There we go. Net profit, 15%. 15.27 would be $127. Or did you decide that was too much? Maybe we wouldn't get up that. Maybe you want to be a little bit more conservative, put it down to 10%. Lan, are you happy with 10%? Okay, let's make this at 10%, see if we can get this off of here. That'd be $85. Are we up $85 right now? No, we're up $7. So it's not going to take it off right now. It's going to wait until it makes $85. Then it will take it off. So we're going to go ahead and we just hit place order. Don't market order into that. That's what I did yesterday and screwed up, right? I'd set this thing all up, and then I went and out of habit, I went and put market order. I want to leave that at net credit. So we're going to come in here. We're going to get a net credit of $85. We're going to hit place order. Boom, that order. Now it took it off. So it gave us our $85. No, it didn't. It took it off at $22. How come I just screwed that up again? I don't know what I did wrong. Let's try it with this one. Come in here. Liquidate multi-leg. Okay, net loss. No, net profit. Run it to net profit. Net profit, we want to come up here to make, let's do 20%, 8 to 19, 20, $62. Place order. There it is. That one worked. I wonder what I did wrong last time. I have to go look back at the video. Anyway, that's how we do it. Now we have a limit order that's sitting out there that says at 15%. I think that's what we put it at, right? 15%. It's going to take that thing off. You're like, well, I want to make adjustments to that, Lan. I don't want to have it be 15%. I want to be 10%. Well, all you have to do is just right click on this little order and say delete the multi-leg. So we delete the multi-leg order that we clicked on, which is the one, not the one that we're in. This is the order that's pending. You can see it down here in the orders. So you can see pending. We can do it down here too. So we can right click on this and say delete. So I just deleted the limit order that's going to take the profits, and I'm going to reset it, put it on there again. So now we just come and do it again. We say liquidate multi-leg, and we just put it on there again, pulls up the little calculator. We can change it to something different. I think I might have had that at the negative number instead of the profit number. I don't know what I did wrong. I'm going to go back and look at the video. I wanted to have that take a profit off it. We can put it back on. Okay, we're going to come in here and let's set this back at 20. Last time we had it at 20%, right? So we can put it at 25%. So we'll put it up at 25%. I made my adjustment. I go ahead, place the order. Now I got a new limit order. So you can always change it. You're not stuck with what you did. You just delete it and put on a new one. So you can do that either down here in your orders or in your positions. Let's go put our straddle back on. That kind of upsets me that I screwed it up. So back to 0 DTE, we're going to buy a call. We're going to do it. Oh, there's not one right at the money. We have to do either in the money or out. Oh, that's pretty close. We'll go here with this buy the call here, and we'll buy the put here. And we got them both in there. We're going to go ahead, and this is where we're going to market order into it. We just market order into it because we are in the demo account. We don't want to bid for it. We can bid for it. They actually let you in the demo account bid for it, so we should probably do that. Practice it. All right, so now we have our our new straddle on there. So now let's go ahead and set that up once again. We're going to liquidate the multi-leg. We're going to come in here, and we're going to have a net credit, and we want to go net loss, net profits at 0 because we just put it on. So now we're going to run this up. Oh, that's the negative, net loss, net profit. Okay, here we go. Let's go into the profit zone, and we're going to put that up here at 20. We're just going to run that up until that little calculator says 20%. Keep going. Come on, we want 20%. 18, 19, 20. So back it off. There's 20. $157. So when it makes us $157, just going to pull it off. I'm going to go ahead and hit place order, and boom, it worked that time. All right, I didn't take it off accidentally. Okay, so there we go. We have a straddle and a strangle, and we have limit orders on both. You can see over here in your orders, we have limit orders on both. Going to pull them off once they hit our target price. What's your target price? We said 20% on one. Where's it at, Lan? I can't see. Where's it going to pull it off at what percentage? They don't give us that information at the exchange. They don't send that back to you. If you want to see it, you have to go take it off and put it on again. And then you can see the little calculator. But once you put it on there, they take the little calculator away and you just see what you see here. That's the nature of the beast. I want to see more information. Okay, well, write a letter to New York City. Good luck with that. Okay, Claude's asking, I am asking why options plenty of leverage with the ES futures. It's a little different over here, Claude. I will answer that question. Let's come in here and take a look at the options chain. Now, when you look at the options chain, you have this thing over here called Delta. What the heck is Delta? I know it's a place you live in Utah. There's a town called Delta. Yeah, Central Utah, Delta. No, that's not what we're talking about over here. Delta is the difference between the underlying, in this case, stock index and the option. So I oftentimes say that when you buy an option, you have way big leverage. Oh, I'll buy options because you get big leverage. Not in the futures market. In the futures market, it actually reduces your leverage. It's not exact. I mean, I'm just kind of I'm fudging things a little bit here. But the fact is, when you get in with a futures contract, let's say you get in with a futures contract, and all we're doing is day trading. I'm not talking about beyond day trading because then the rules change once again. But when we're trading, when we're day trading, and you come into the futures market and you pull up the S&P 500 and you look at your key, you have a day margin. You can actually trade one contract for $750. Well, one contract represents $50. S&P stock index current price is $4,778 or $238,000. So with one contract, you have the leverage of controlling $238,000. Isn't that crazy? That's why in the futures market, you can draw a little dollar calculator. And let's actually get off the S&P, or we'll go to S&P. We got all this stuff on the screen on the S&P. So let's go look at a different market. I know you want to know the S&P, but it's the same for the others. Same for the market. It's just that we don't have options on them. So I can go Let's go pull up the Russell, NASDAQ. Let's just go do the Dow daily chart. So we're talking about actually 1 minute chart. So we have a margin amount because we're on margin, meaning that you're basically, you don't have to put up the entire amount. You're not trading a cash account, so you don't have to put up the entire amount to control one contract. One contract in the futures market, and this is why we love to day trade it, because there's no pattern day trading rules, first of all, and you can get in with one contract for $750. Well, how much does $750 represent? Well, it represents, in this case, current price 37, it represents $188,000. So it's like buying $188,000 worth of stock in the Dow, only you're controlling it for $750. That's your leverage. So in the futures market, you have a tremendous amount of leverage already. Okay. If you were to go over to the stock market, and I could pull this up and do an S&P comparison, or a Dow comparison, and we look at how much money you would have to spend to make the same amount of money in the futures market versus the stock market, I'd recommend you do that. Go drag your dollar calculator up there. We've done that in past, but the point is, you have a tremendous amount of leverage already just by trading contracts. And we have minis and micros. And micros, if we pull up the micro, look at this. Even the micro is huge. I mean, you don't realize, we as traders over here, we're like, oh, I don't want to trade the micro. It don't make enough money. But the micro is huge. If we come in here and I pull up the Dow micro, let's go in here and do that. Pull up the Dow, A, B, C, D, Dow micro mini. Look at this. Watch this. I'm going to pull up the Dow micro mini. I'm going to go down to a 1 minute chart. Okay. It looks exactly the same. There's the mini. There's the micro mini. So let's come in here and draw a dollar calculator. From this low to this high, that's $525 profit. $525 profit. You're like, well, that's great. $525. Great. How much did you have to invest to make that? This is the mini. We had to invest. Right now, the key is telling us $750. What? $750 is all you had to put up to make $525? Yeah. You already have a tremendous amount of leverage in the futures market. Okay. So that's a lot of leverage. Let's go down to a smaller market. This is the micro mini. There's no options in the micro mini. Let's bring the screen down. So this is the micro mini. Let's draw that same dollar calculator from top to bottom. $53. You're like, well, that sucks. I'm only making $53. I don't want to make $53. It's not enough. Okay, well, look at the key. You only had to have $75 to make $53. Look at the leverage on that. It's huge. It's huge leverage. All right. Even in the micro mini, you have huge leverage compared to the stock market. So then you're like, well, options give you great leverage, Lan. No, that's a rollover from the stock market people who believe that. Stock market, yes. Stock market, you have big leverage. We already have big leverage. Yeah, we have big leverage in the futures market. So when you put on an option, you actually reduce your leverage. Is that crazy? Yeah, it's crazy. How does that work, Lan? How does it reduce your leverage? Let's go talk about that. If we come over here to the S&P 500, back to the S&P. All right, I'm going to bring up the window. Bring back up our window. You have this thing called delta. All right, and it's all about the delta. Delta and convexity. You hear me say that all the time. Oh, that's the convexity. Oh, that's the delta. Delta and convexity. So what this is telling us is at the money, which is right where the market's trading, the option or the strike price, it's at the money, right where the market's currently trading, is your at the money strike price. You can see that right now is right where we got our orders placed, right here at $397.50. That's the premium or the price, right? $397.50 is the premium we'd pay for the $47.80 call. Okay, great. You bought yourself an option. How much did we have to pay to buy a contract? And this is in the mini. $750, right? We had to pay $750 to buy one option with a 0 DTE, or no, not 0 DTE. That's a contract. So we have one option or one contract. Getting confused. Hope I'm not confusing you because I'm confusing my head. Let's get this straight. When we buy one contract in the S&P 500 mini contract, we have to pay $750. We don't actually have to pay it. That's our margin. It's a performance bond that we have to put up. We don't actually have to pay it because once we close it out, they just give it back to us. So we have to have $750 in our account to put on one contract. Okay, $750. So here's where the leverage comes in. To put on one call option, we only have to pay $388, which is about half, right? About $400. So we buy that for $400, the premium of the option. That's your leverage because you're only putting on half the amount, right? But look at the delta. The delta is 0.50, which means you're only getting half, because a delta of 0.50 means that it's going to make 50 cents for every dollar that the underlying contract makes. So that means you're only getting half the leverage, half the amount of money. You're only making half as much money as you would if you had the contract, because it's got a delta of 0.50. Where your leverage comes in is that you only have to pay $375 for that 0.50 as opposed to $750 for that 0.1.0. Did that make sense? One contract makes 100%. One contract makes delta of 1.0, right? A contract is always a delta of 1.0, but an option has a lower delta, has a delta. They started at 0.50 at the money, and convexity causes it to either go up or down. I can show you that in the calls. We come here to the call list. You can see your delta over here, 0.50 right there, that one right there, cost us $383, basically 50% of the value of the underlying contract, right? And the delta is 0.52, meaning you're only making us half. So it's kind of like having one contract, only half the leverage and half the cost. So it's about like cutting the cost in half. So that's where you get your leverage on the option. It's not really increasing the leverage. It's just kind of the same leverage. In this case, you can see it's almost exactly the same for a 0 DTE option, but you're getting half the leverage, half the delta. Where the increase comes is as time goes by and we get to expiration. At expiration, the delta will be 1.0 on this option, and you only paid $393 for it, whereas one contract would have been $750. So you paid half for the premium of the option as what you would have had to pay for the contract. But when you bought it, you only had a delta of 0.52, but convexity at the end of the day will bring that to 1.0, and it's going to be 1.0 whether in your favor or against you. And remember, you have to pay for that $391 in the option. You don't have to pay for it in a contract. Contract, they give it back to you. You just you realize your profit or loss, and they put that profit and loss against your account, and they give you back the premium or the $750 that you had to pay on the margin amount. Okay, they return that to you. So you actually have to pay the premium on the option with a delta of 0.50. Okay, so your market has to make, by the end of the day, has to make at least $400, or else you're going to lose money. It's got to make at least $400. Now, it doesn't have to make that. That's by end of day. If the market takes off and runs, it can make money. It can be profitable before the end of the day. You don't have to liquidate it or wait for the end of the day to happen. It can take off and run and make money prior to the end of the day, and you can liquidate it and take your profits. And that's what we've told it to do with these orders, right? I know options. For those of you who have taken the class, been part of options, you're following along, you're saying, yeah, I get it, Lan. I understand that. That's cool. Great. Thanks. For those of you who haven't done options, you're like, what in the heck? This just went right over my head. Stick with us. Come back. We'll do more of this. Just giving you an introduction. And so I know sometimes it seems a little complicated, but it doesn't have to be. Okay. So that's how it works over here in the futures market. That's your leverage differences. It's the premium that you're paying against the delta. Okay. So that's to use a paragraph where a sentence would have probably done. All right, let's come back and see what's going on with these other markets. Let's close this down. What have we got going on here? We got the S&P. That's running our option strategy over there. We're down $70 on it right now. You can see we got the Russell, which is down here. We haven't placed a single day trade order on the Russell. We got the Dow, which is a daily chart. We can close that out. We got the Dow Micro Mini. We are not trading that one right now. We can close that out. Lan, you were telling us about the Micro Mini. Well, I was telling you about the Micro Mini in relationship one versus the other, right? But I think we kind of got that. Hopefully we got that. So now we've got the Dow Mini. So we've got the NASDAQ range bar 50. Okay, so do we want to turn on the autopilot? So let's come here, delete all those. Okay, so what's going on with Russell? It's bouncing back and forth across the VWAP. If we were day trading, paying a little bit more closer attention, we took the market went bullish right here, and the first buy signal after the bullish arrow was the break from red to green. So that was our buy signal, and that would have been a good buy signal right there. So that's our market change from bearish to bullish. First green candle after the pullback red bar. That's our first buy signal. Why don't you just trade the arrow, Lan? Sometimes you can do that. You can just trade the arrow if you want to. But remember, the arrow is just telling you the market has changed from bearish to bullish. And then your first buy signal is actually a little pullback after that arrow. You get your red, and then the first green candle is your actual buy signal. So that's your buy signal. The market's rallying right now. How much would that have been? Leveraged in the futures market, we're going to go up. That's $175 to where it's currently trading. We'd have probably got out when it hit that red bar, but that red bar would have got out right there with $175 for every single contract. Each contract in the mini was $750. So you'd have made $175 on a $750 investment. They'd give you back the $750, and you just kept this $175, right? What if I'd have done it with an option, Lan? Well, it'd probably been profit would have been probably half of that, or even less. $175, delta of 0.50, and your cost would have been half, right? Probably about half, $400 as opposed to the $750. You'd have made about half. Everything would have been about half. Okay, so there you go. So now we're looking at the Dow. What's the Dow? It's a little different. It's got yellow bars in there, red bars, green bars, yellow bars. It doesn't look like the Russell. Well, that's because we got the bulls and bears turned on. The bulls and bears is our calculation for Fibonacci and Elliott wave. So if you want to know where the Fibonacci sweet spot, which is what we talked about earlier, the Fibonacci sweet spot is color-coded. So if the market's going through the Fibonacci sweet spot, the price bars are yellow. That's why we have yellow bars, because they're going right dead center through the Fibonacci sweet spot between 38.2 and 61.8. That way you can see just by looking at your charts without having to draw a stupid Fibonacci ruler every time you want to see where the Fibonacci numbers are. Not that that's a stupid thing. That's a great thing. We love it. We love it. It's just that you don't have to want to, sometimes you don't want to draw on it every time. You just look at the chart and say, oh, there's the yellow bars. Must be going through the Fibonacci sweet spot. Okay, that's what that means. So that's what the bulls and bears does for you. All right. Plus, the bulls and bears has some Elliott wave count tools and that kind of stuff. So that's what we're seeing down here on the NASDAQ 100. We got the bulls and bears turned on, but we got different settings. We turned off the sweet spot. Right. So this is, even though it's the bulls and bears, has no sweet spot. We've removed the sweet spot. So now we're just getting red and green bars, but we're getting the blue lights. The blue lights are also part of the bulls and bears. And so they give you this kind of Elliott wave count system. So you can count the Elliott waves, but it's not making Elliott waves. It's just going sideways. So, but we might be able to scalp off of it. We'll do the David Duty scalp. You want to do the David Duty scalp? We can set that up in the autopilot. Let's go ahead and set that up on the S&P or on the NASDAQ. Just come over here to the autopilot and we'll say NASDAQ scalp. And we've already got it all set up. All we have to do is turn it on because we saved it, but we'll go down through it anyway and make sure everything's straight. We're going to trade with quantity 2. We don't need any of the time restraints because we're going to be sitting here running it. We don't need to, we're not going to walk away. We're not going to go to Cancun. And we're going to come down here, entry strategy. We're just going to get in with a market order. We don't need any thrust bar signal preventers because we're on a range bar. There are no thrust bars. We don't need any inactive signal preventers because there are no inactive market signal preventers because we're on a range bar. Those are for minute bars. We're going to take the trend. Now I've got this set up to take the trend because usually we use the bulls and bears as the trend tool to take signals off the ATR or some other more aggressive indicator, right? This time we're using the bulls and bears to take the signals. So we need some sort of a trend. So I put on the moving averages. So I've got the moving averages set in there, and the moving averages is set to an exponential of 28. It's a little bit more aggressive. David Duty likes to use 50 for those of you who are tracking David Duty. We're going to use 28. I like to use 28. Okay, so now we're going to come in here and we're going to say ticks the stop. We're going to put it back at $200. What? You're going to risk $200? Well, not exactly, because once we put it in, we drop it, we immediately come down here and move it to the blue light so that it'll trail with the blue light. That's what that's saying there. We're not going to use any jump stops. We're just going to drop it at 40, immediately jump to the blue light. Okay. And then we're going to limit. We're going to put a limit at 22. That's David Duty's number, right? $110. $10 covers the commissions and fees. And then we take our $100 out of the market. This is a scalp and scalp. This is not scalp and trail. And then we're going to come in here and we're going to exit on primary signal. And that's only if we get a reversal signal without having it stop us out first. We can just reverse and take it out on the reversal signal. It's kind of a safety net. All right. All we have to do now is just say, you ready to do it? We didn't change anything. We'll save it. We didn't change anything. Start the autopilot. There we go. Now track and trade is going to take over. And it's going to trade that NASDAQ strategy, that range bar 50, based on those settings that we just set in here in the autopilot. So now we don't have to do anything. We can go to Cancun. No, I recommend you don't go to Cancun. Sit here. Watch it. Okay. All right. So now we have our auto trading set up on the S&P 500, automatically trading our straddles and strangles for us. So we don't have to deal with it. Track and trade is going to watch that and take care of it. The NASDAQ 100 is being traded by the autopilot, and we're trading the bulls and bears without any neutral zone. We're just going from red to green. And so that's just a very aggressive trend strategy based on, but we've also got moving averages. So as our filter. So that's being traded over there. So that's why I've moved those over on that side of the screen. Okay. So those are now sitting over on that side of the screen. And on this side of the screen, I've got my Dow, and it's on a 1 minute chart. And I've got my Russell, which is on a range bar 10 chart. Both are using Heikin-Ashi bars. So now if we wanted to, we could start day trading some of these. The market's being a little stupid today. We did have a couple of good little runs. We could try and see if we could scalp a little out. We're not going to get much of a trail because the market's just not trailing today. Look at this long, ugly sideways trend. So we were going to look and wait for that to break out of that big, long, sideways, ugly trend. Lots of topping tails, lots of bottoming tails. So if it broke out, we would wait for it to... You want to take the breakout, Lan? No. I want it to break out, prove to me that it wants to go, either one direction or the other. In this case, it looks like it wants to go down. I want to see a small pullback, and then that would be our trigger for the next leg down. All right, so that's what we would look for. I don't want to take the breakout because we get lots of false breakouts. So these were all false breakouts in here. You know, this little thing was up here a little earlier. And if we take all these false breakouts, we get our hiney handed to us. So we have to be careful not taking false breakouts. So we just don't take the breakouts. We wait for it to break out, come down, give a little pullback, and then oftentimes it'll come back and use this line right here, this area of support right now as resistance, and then it'll turn, and that's where we get in. And that's where we take our next level. We get in at that point. We're losing $125. You can't see that. Let me come in here and move myself. There we go. We're losing $125 on our options. Our options are not making money. We put them on, they were rallying. Now they're pulling back and going the other, they're just sitting right there, dead center of our order. So they're not going anywhere, and we're losing time value. Remember, this is the march towards decay. We're losing time value on those straddles and strangles. Plus, the market was moving pretty good when we put them on, too. So we had a little bit of implied volatility in there. All right. So what are we doing? Okay, let's watch this Russell down here. You got the Russell. It's in a downtrend. Notice we have a down arrow, meaning that the market is bearish. So we shouldn't be taking long positions. That would be a reversal in anticipation of a continuation of the uptrend. But you have to decide if you want to do that. Chasing reversals is a very difficult game. But the market did come up, had a nice rally. This is in a little pullback in here. So we got this little pullback, and it could give us a bounce off that VWAP. Claude likes the VWAP, so we're bouncing the VWAP, and we're going to break the blue lights right, or the little yellow lights right here. And if that comes in, breaks the little yellow lights right there, that would be a buy signal, and you could anticipate a continuation of the uptrend. We could take it, put one on right now in anticipation of a continuation of the uptrend. If you want to do that, you want to do that, Lan? Yeah, let's put one on. Just, it's not the best, but it's okay. This is the next buy signal across that peak right there, the inner peak of that triangle. That's a little wedge pattern right there. So we're looking for the breakout of the wedge pattern to the upside. The first test would be this previous high right in here. So that would be your scalp. See that little high right there? Let's bring this full screen. Oh, what's happening? See, good thing we didn't take that short position on the Dow. That false breakout to the downside. It turned around and went right back up into the channel. Let's bring this full screen. Let's zoom, 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 and we'll see what's happening. Oh, of course, Lan got in, so it's going to go down. Okay, we got our stop back here. We need this thing to break higher. We put one on as it started to break above those yellow dots in anticipation. Take the arrow, Lan. Take the arrow. Well, it did, and it's going to fail on us. Yeah, it's going to fail. We just get out. So we got our little, let's get rid of all these drawing tools. So we got this line across the top here. This is a triangle wedge formation. See that? That other market's going through a neutral trend too. Let's go flip over there and see if we can see it. Nope, the wrong one. There it is. So it's going through the neutral trend. See that? See how it's rolling just through that neutral zone? It's on a rebound. So we would think the market would come up, down, and go back up again like that. Okay. So let's clear out all this drawing stuff. Draw our trend line across here, all the way across the top, just like that. Okay, and then we got these areas of resistance. We got a little line here, little line area of resistance. We got another little line here, areas of resistance. Previous high. This one kind of not as strong, but it's a little area of resistance in there. This is our big area of resistance in here. This would be if the market broke to the upside. It doesn't look like it wants to do that, though. It looks like it wants to sit down here and just fiddle around neutral right now. Have we got anything coming up that it's waiting for? 9 o'clock. What have we got? 6, 8, nothing. 10 o'clock. Everybody's waiting for Fed Bar to speak. So at 10 o'clock, we got 1 hour for him to speak. The market will probably be a little bit lazy until then. Wait to see what he has to say before they start to move. Oh, we're breaking out the bottom side of this. So we went long right here. It failed on us, thinking that we were looking for this market to rally up, come down. The first continuation failed, come back, and we oftentimes go on the second continuation. And that didn't happen. So when that failed, a lot of traders are like, well, if that signal fails, and what do we always say? The best signals are the failed signals. Then that's why the market's tanking right now. Because that signal failed. And that's a very strong, powerful signal for a lot of traders right there to see that second breakout of that triangle wedge formation. And when it failed, they're like, that's not good. It shouldn't fail. And if it does, bam, that's why the market tanked. We should have been wise. We should have been wise to that. When it failed on that second attempt out of that triangle formation, we should have been wise to see that it was going to fail. Take the short. But I didn't. All right. Well, let's wait for our next opportunity then. All right. While we're waiting for something to happen here, something just happened, Lan, and you missed it. I know. Wait for something else to happen. That's the thing about trading. If you miss one, just keep waiting. Another one will come along. There are lots of opportunities. You just have to decide which one you're going to take, which ones are the highest probability, lowest probability. Put more money on the higher probabilities, put less money on the lower probabilities. That's the name of the game, right? All right, what am I going to do? I'm going to pull up our spreadsheet for yesterday and show you what happened, because you guys are all want to know what happened to the trades yesterday, right? You were here yesterday. You want to know what happened. So let's go look. 2023, 2024. I got a new spreadsheet. I'm not quite done with it. How come it's not coming up? Come on, new spreadsheet. So here's my new spreadsheet. This is the new 2024 spreadsheet I started working on. You guys want a copy of it, just let me know. I'll let you have it. $42.50. That's all we ended up with yesterday in the classroom account. Lan Turner, lucked out. Day traded a bunch today. Finally ended up for my day trading at break even. Mostly traded the range bar 6 and 10 on the Russell. Got down on my very first trade. Spent the rest of the morning just trying to dig ourselves out of the hole. Remember that yesterday? My very first trade, we went down $150 or something, and then we spent the rest of the morning trying to get out of the hole. But we did. We also, based on the trend of the daily chart, bought a put option, but the market was bullish all morning, so my put option ended up losing money. Fortunately, my autopilot scalp on the bulls and bears system hit and paid out $122, covering my open loss on the options. I had put on a new put option as an example of how to set a limit order on my option, then just closed out that option with $20 profit, ended the day green with $42.50. Pure luck green day. I had a hard time calling anything I did today skill. Had a hard time calling anything I did today skill. It was all pure luck, but we ended up green on the day. All right, so we had the autopilot paid off and made enough money on our autopilot scalp to pay for the losses on the option that we had on. Ended up yesterday with a $42 green day. All right, so that's what happened yesterday. Those options didn't make any money, but the autopilot paid off and paid for the losses on the option. Pure luck. All right, what's happening here? This is a downtrend. Let's pull it back up, go full screen. Oh, that Dow did break down lower. So this here is now a downtrend. So we're in a downtrend, right? Down, and then we get a little ABC pattern. So this is a pullback. So we would look for another break and a continuation of the downtrend. But this market hasn't been following through. Hasn't been following through with ABCs today. It's been going up and then it's gone sideways. And then it goes down, it probably goes sideways. Goes up, goes sideways. Goes down, goes sideways. Goes up, goes sideways. There, it made a little ABC, but it's just kind of not really following through. Here it kind of in an uptrend. I mean, if you look at that, that's 3 drives. Drive 1, drive 2, drive 3, right? So there's a 3 drive pattern coming through on this range bar Elliott way, or kind of on the longer term time frame. So there's our 3 drive pattern. That was morning. That's 8 o'clock. So drive 1, drive 2, drive 3. Coming up here, peeking out, falling back down, ABC. So if we get the ABC down, this thing should fall and come back. How far? 50%, the last major move. All the way from the bottom to the top. Oh, look, it came just with that first drive, came all the way back down to 50%. It lost 50% of its value in that one drive from there to there. Everything it took it to go from here to here took all morning, starting back here at 7:45 a.m. Chunk, all the way to that peak. Took all day from 7 to 8:30, hour and a half. It lost 50% of its value in one drive. Boom. 50% down. So now it's trying to claw its way back up. Let's wait and see what it's going to do. Range bar 10 land. Range bar 10. Do you like that range bar 10, or should we go look at some minute charts on here? I don't know. We can do that. How would you do that if you're going to look at a couple of different time frames on the Russell when you got all this other stuff going on here that you want to kind of keep your eye on? Well, remember, this NASDAQ, we can't close that because the autopilot's trading it. If we wanted to, we could come up here to our charts and we could come in and we could go and just select it out of our portfolio. I've got lots of portfolios in here. So I've got a portfolio in here just for the Russell. I could come down to my Russell portfolio and it would open up the Russell and give us 4. I got 4 charts in there, all different time frames on the Russell. But if I did that, it would close out the NASDAQ. I can't do that. I could close out the S&P. I don't need that one open because the S&P has orders on it and has pending orders, but those orders have gone up to the exchange. So this is just a representation of what the exchange has. So on the options, we don't need to keep that open. We could actually close that window and it would still function properly. But on the range bar, the NASDAQ, where we're trading with the autopilot, we can't close that window because that's actually track and trade is actually managing and handling that. So it's trading that page. So we can't close it. So you're like, well, I want to see a couple of different time frames of the Russell, not just the range bar 10. Okay, well, let's do this then. We can minimize it. We can't close it, but we can minimize it. What's the difference? Minimizing means that it's still active, it's still running, you're just not seeing it visually displayed in the software. So the way we do that is we click up here in the right-hand corner. I'm going to minimize the NASDAQ. All right, so the NASDAQ is still here over here in our window. See up here? Still there. Range bar 50, still there. Has AP next to it saying the autopilot. Autopilot is trading. So the autopilot is trading. It's still there. It's just not displayed over here. So now what we want to do, we're going to do the same thing to the S&P. Let's go ahead and we'll minimize that one. Still there, still here, still in our book, just not being displayed. So it's still active, it's still working behind the scenes. So I was talking to one of our other students, and I was mentioning that we have to make sure that we don't have 42,000 stocks over here in this window, all minimized, only looking at one stock, because then your software has to sit there and ka-chunk, 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 bringing in all this data, and it'll slow your machine down if you have too many charts open. So if you got like what I'm doing here, I mean, I'm projecting on a YouTube channel, I'm screen capturing, I got multiple windows open, I got lots of charts open, I've got browsers open with lots of things going on in all the browser tabs. My computer is like the CPU is like at 100% all the time. So the more I make my computer do, the less it's CPU power it's got to give to track and trade. So reducing the number of charts that I have open, all that kind of stuff can help speed your computer up if you're having speed issues. So reduce the load on your computer and your track and trade will be more responsive. And the biggest thing that slows it down is I see sometimes I'll go and help people and look at their charts, and they'll have 32 charts over here in the right-hand window, but they'll only be looking at one. Well, track and trade is still processing all the data for all 32 charts over there, even though you're only looking for one. So you have to be mindful of the fact that you're asking track and trade to do a lot. That's a lot. That's a lot of work. So that might slow things down. So if you don't need those charts, don't leave them open. Okay. And then don't project to YouTube, because that slows things down too. All right, let's see where we're at. This is the Dow. Do we want to still continue to watch the Dow while we're watching the Russell, or do we want to watch the Russell on different time frames? Let's minimize the Dow. I'm not going to close it, just going to minimize it. Still there, still working, still functioning, still taking up CPU power. Okay, look at this. So this thing's just snaky, 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 back over and back and forth across that VWAP. So it's not really getting any trend. Everybody's sitting around waiting to see what the Fed wants to say. That's what's happening. That's why it's a little slow. So I'm going to show you how to do this, and then we're going to call it a day. So I'm going to come in here and right click on here, and I'm going to open up a 1-minute chart. I'm going to open up a 15-minute chart, and maybe we'll even open up we got 1 minute. We'll open up a 2-minute. So now I've got 4 charts, 1, 2, 3, 4 of the Russell. None of them are being displayed. All I have to do is click this little thing right here, select this window here, and now I've got 4 Russells on the screen. Up in the upper left-hand corner, I have the Russell 10, range bar 10. In the upper right-hand corner, I have the Russell 2000, which is a 15-minute chart. Bottom right corner, I have the Russell 2-minute chart. In the bottom left corner, I have the Russell 1-minute chart. So let's reorganize these. I'm going to put the range bar 10 up here. Just grab the header and drag it. We'll put the 1-minute over here, put the 2-minute there, we'll put the 15-minute up there. There we go. These are all still the Russell chart. Remember, like we talked about earlier, these are all still the Russell. Now, I've got Heikin Ashi on, I don't have Heikin Ashi on the 15. If I wanted to turn Heikin Ashi on the 15, you might say, well, that's easy, Lan. Just go up there and hit the HA button. Well, that would change it on all 4 charts. So if I hit it, boom, oh, that's going to turn off my autopilot. I can't do that. So I'm going to bring this full screen, hit HA. That turns it on just this chart. Okay. So that's just that chart. This one here doesn't have Heikin Ashi. How do you know if it has Heikin Ashi on or not? Well, first of all, you can look at the bars and tell. But second of all, it says it right up there in the upper left-hand corner. It says HA. So let's come over here to the Russell. This one doesn't have HA in the upper left-hand corner on the 2-minute. So let's go turn on Heikin Ashi on the 2-minute. I'm going to hit HA. Lan, my software doesn't have the HA button. Well, that's an added feature. You right-click on this little handle, say Customize Toolbar. It opens up this little window. Again, right-click on that little handle there on the button bar. Gives you this little window. Come down in here, in this little window here, find HA, and then you can click on it, hit add, and it's going to put it over here into this one. Then you can move it up and down and put it where you want it over here in the button bars. It doesn't come out of the box. Track and trade doesn't come out of the box with HA up in the list. You have to add it. There's a bunch of stuff in there, all kinds of little buttons that you can add to your track and trade that aren't in there in default. Okay, so that's why my button bar looks different than yours. Where do I get track and trade, Lan? I'm new. I don't know where to go get track and trade. Oh, glad you asked. Go get track and trade. Oh, you're in the way, Lan. Can't see. Go get track and trade. I don't know how to make this work. Go get track and trade. We'll put you up there, Lan. Go get track and trade over at trackandtrade.com. All right, trackandtrade.com. Get the futures version. If you want the stocks version, get that too. It's free for 2 weeks. Go get it, and you can come along, install it, and do what we're doing over here. It's a lot of fun. So go get your track and trade at trackandtrade.com. Download it. It's free for 2 weeks. You can try it out, play with it. If you like it, then you can go ahead and subscribe to it. But otherwise, do what you want, right? While I'm here, I might as well tell you about Pit News Magazine. Everybody needs to get Pit News Magazine. This is how I communicate with you. Oh, man. February is going to be an amazing version. I've got an interview with somebody that's going to knock your socks off. You guys are going to love the February version. January version, really good. How many of you are enjoying the January version of Pit News Magazine? That turned out pretty nice, right? So get this magazine so that you can stay in touch with us. And the February issue, you're going to love the interview in Pit News Magazine. So go ahead and get that. So one full year is $49. You get the first 3 months for only $1. That's your test season. See if you like it. You get 3 issues for $1 just to see if you like it. After 3 issues, if you want to keep it, you can pay the $49.95 and get an entire year for only $49.95. What's great about Pit News Magazine is not just that that's where we communicate. You can listen to the articles. You can read the articles, and there's also videos. This is a multimedia magazine. It's amazing. So everybody wants Pit News Magazine. You should. Everybody want it anyway. So go get it, pitnews.com, $1 for 3 months. And you're going to get the interview, that interview that's coming out. It's going to be a multi-part series. It'll probably be in the February, March, and April issues. So for 3 months, you're going to get that interview for $1. Ooh, that's crazy. It's going to be an amazing interview. Can't tell you who it is, because if I did, I'd have to kill you. You know how it goes, right? All right, what's happened here on Range Bar 10? All right, guys, we've been here for quite a while. I'm going to let you go. Been a long class, and we've learned a lot. Fed you with a fire hose, so hopefully you were able to glean a little bit of what we did today. Learned a little bit. We've taught a lot. Hopefully you had some good learning going on. And I'm going to let you go, and we're going to catch you tomorrow, and we'll just follow up, start off right here, and I'll let you know what happens with our options. All right? So we'll see you tomorrow.